Benj. Thanks for being with us today.
Thanks for taking the time of the day, Todd. I appreciate it.
And I understand we're coming up on one of your favorite seasons. Can you tell us why?
Well, this is tax loss season. It's the time of year when a lot of people dump their stocks. That means that we can get better bargains. So we generally do most of our buying at this time of year. We're in our 27th year at Contra the Herd, and I've been doing this a lot longer, and I find this is a great way to get bargains.
So, what percentage of your buys do you think happen in this season, just out of curiosity? Just a rough number, would you say?
Oh, I would say about 75%.
Is it really? It's that high? Wow.
So say in November, December, most happening in December, and it's a constant. It's kind of like people who are going to shop for the holidays or shop for the whole year, perhaps. A lot of them will do it on Black Friday. A lot of people will wait until Boxing Week, but you can buy things at 50 cents on the dollar. I'm not saying with the stocks it's 50 cents on the dollar, but certainly you can get a lot of bargains.
Do you find that tax loss selling tends to be amplified in December? Is that the case, or why December in particular?
Well, it's an excellent question. What happens is it's kind of like people at work or at school, and they tend to wait until the last minute to do their assignments. So they might know months ahead they have to do it, but then in the last 2 days, all of a sudden they'll really get busy on it. It seems to be part of human nature. So tax loss selling, you can do it any time of the year, but a lot of people just wait until towards the end of the year to do it. At Contra, I tend to do a lot of it in, say, May, and do it before the summer. The old expression, sell in May and go away, because markets generally don't do as well during the summer. So we look at it differently, but year after year, people seem to do roughly the same thing. It's one of the good old cycles of stocks.
One of the few anomalies, perhaps, or market inefficiencies, I should say, I guess, in markets. Do you think there's an element of momentum that is a factor here as well, in that if tax loss selling has been going on for some period of time, people might sell for reasons other than tax loss selling, like almost like panic selling? Is that a factor at all?
Well, I think some people who wait until the end of the year, if they see that things are going down, they might decide then to jump the ship. So it could be amplified. It's all based on the old laws of supply and demand. And if there's a lot of supply that comes into the market, it knocks down the price. This year, in some ways, I think could be different because stocks have done so very well that a lot of people have made an awful lot of money. And there's potentially far less that they can sell for the tax loss so that they pay the tax people less. So this year there could be more people trying to get out of some stocks. And when that happens, if they do, that means there'll be more bargains for the likes of me. And I think it's special this year because, again, the gains have been phenomenal across a broad spectrum of stocks. And this year, there just aren't as many that people will be dumping to take that tax loss. And it might actually be, a bit like a toboggan run, whereas they have to sell certain stocks and then other people will pile in and they want to get out so that they don't pay, again, the tax man as much money.
Okay, interesting. Do you mean as well maybe that there might be relatively better quality companies being sold this year than normal, or is that?
Yeah, I don't know if there's better companies sold on average. I just think you might be able to get the companies that are being tax loss sold at a better price. But I don't necessarily know that they're better. What could happen really is almost the opposite. If the stock markets get killed, say in October, that means a lot more companies could be available for tax loss buying. So in that larger spectrum of companies, there would be more chances and better chances to buy worthy companies. So we're dealing in a smaller fishing pond this year. So overall, I would think that the quality might not actually be as good, just based on the numbers.
Yeah, right. Okay. Good thoughts. Thank you. And so what do you think some companies are that might be of interest or might be some good picks in this tax loss selling season? Do you have any ideas?
Well, this year, there's not nearly as many. Looking at our portfolios, there's some gold companies that I think could be worthwhile. One that I like a lot and we bought in July is Yamana. They just reported results, and all of the mines reported either record or very, very strong earnings. The all-in sustaining cost has gone down, and the price of gold has gone up. So that augurs well for future prospects. They're also bringing online the Wasamac project in Quebec. So that's going to take a few years to do, but it means that there's something coming along at the same point in time. They've also refinanced their debt. All of their debt from 2022 to 2024 has been refinanced at a lower rate. So on all of that debt, they were paying over 4%. Now they've refinanced it at 2.63. So that's going to save them quite a bit of money. So the balance sheet has been dramatically improved. So I think this could be a good year for that company. Another one that I like is GORO Resources. GORO's a gold company. They are listed in the States but based in Canada. They split. So this is the half that's actually remaining. Fortitude Gold is the other part. It's done very well, but GORO hasn't. One of the things some people don't like is they often just have about 5 years left of gold in the ground, it appears, but then they keep on finding more gold. And one of the beauties of this, same as with Yamana, it pays a dividend. So while I wait for both of these companies to turn around, I can be getting some money back. And to me, that's absolutely critical. So GORO is, it's a good company. I think it's pretty strong. They're in the midst of a takeover of Aquila Resources. I'm not sure how that will go. It's going to take a number of years to know till they build it out. But they're trying to diversify to add to the future potential. But of course, to do that, it's going to cost them a few dollars.
Right. Fair enough. Okay. Oh, interesting. And GORO, I think it's come up a bit off the bottom. Do you still think it's as much of a tax selling candidate as it was maybe a few months ago, or?
Well, it would have been a better candidate a little while ago, but I mean the sell target we have on that is 724, so still has quite a bit of upside. That's better than a 3-bagger from here. Same as Yamana. I think that can do better than a double from this point in time. So as usual, both companies are what I look for in terms of 100% plus potential on the gain side. Of course, none of that happens in one day unless there's a takeover, and I don't expect a takeover on these two in the near future.
Okay, good. And going back to Yamana, yeah, you mentioned the Quebec project. How big of an incremental difference is that to the company in terms of production? Do you know roughly when it's complete? What are they expecting?
Well, it's pretty big. One of the beauties of this company is it's so diversified. I mean, they've got the 5 mines going now. I'm not sure exactly how many ounces this will add. I don't know if they know exactly how many it'll do. But they just did a feasibility study on it, and they've just decided to go ahead with it. So they obviously believe there's a tremendous amount of potential just waiting to be discussed.
Okay, good. And just any comments on the economics of mining in Canada these days? I mean, compared to developing countries, for example?
Well, one of the beauties of Canada is it's a safe jurisdiction, same as the United States. So if you're doing it here as compared to some other countries, and many companies have had problems lately because some of the governments in other countries, they've decided that the companies have to pay more money to those countries. So here you know basically the government you're dealing with, you know the regulations that you're dealing with, so that's very, very advantageous. And that's if either of these are a possible takeover candidate, that's one reason that another company might look at them because they know they're looking at playing in a pretty safe sandbox.
Okay. But the incremental cost isn't massively different, I suppose, I guess, that in terms
Well, in terms of labor, it could be. And what we're seeing now is an increase in costs in terms of fuel. That's gone up quite a bit. Labor has gone up quite a bit. So Yamana says that their all-in sustaining costs are going to go down, but that is also with the fuel costs and the labor costs in mind. Of course, it's very difficult to predict at this point in time how much they will both go up unless there's a labor contract in place. But fuel, as you know, has been going up a lot. Inflation is going up quite a bit. And of course, mines will be impacted, mining companies will be impacted, same as the rest of society.
Right. That makes sense. And then I guess following up with that, do you think, is there more automation in a Canadian mine, for example, versus a mine in a developing country where labor is cheaper? Is that true, or is it similar sort of process?
That could be true to a certain degree. Yeah, it depends where, because if labor costs are really cheap, as they are in some countries, indeed, then it's not as worthwhile to automate. So, and they're looking at different ways to automate over time now. AI, etc. The world's dramatically changing. So over the next decade or so, that could also happen more in the mining industry. It's an interesting question.
I guess if you think, I'm just thinking kind of to, I think it was Elon Musk's comment some time ago about, 90% of jobs in the future will be replaceable by AI.
Yeah, we've heard that for a long time too. I mean, I don't know if it's going to be 90%, but certainly, I think it was last month, more robots were ordered. I guess it's in the States than at any point in the past. So some of those robots certainly will replace people. But at the same time, we've seen that employment has bounced back not after the pandemic, but bounced back compared to early days in the pandemic. So companies need people. Right now, the number of people that companies are looking for, and I'm not just talking mining, of course, it's very, very high. So there's a lot of people who, for whatever reason, have decided not to work, or maybe they don't have the skills to work in certain areas. But I look around here in Toronto, and I see all kinds of signs for companies that are seeing who they can find, looking for people. So,
Wow.
So you may have more robots, but you also have people who are desired at this point in time.
Yeah, right. Okay, good thoughts. Thank you. And then I guess the other question would be, do you have any other picks outside of the gold sector? I suppose there's...
Yeah, there's lots of other companies we're looking at. Again, I'll stick with the portfolio, and I'll give you three that are outside of Canada. One is Aegon. It's been in the portfolio for years. We bought it at $7 and change. It's sitting around $5 right now. They're based in Holland. They're into insurance, wealth management. They brought in a new CEO about a year and a half ago. He's been making pretty dramatic changes. When those changes are being made, it leads to a lot of write-downs. So that's what happened last year. And last year they lost money for the first time in a decade. I think that this year, or 2022, a lot of those changes will be fully implemented, and that'll certainly help the company a lot. Another company is Santander. Banco Santander is the biggest bank in Spain. They're also in Brazil, Argentina, the United States, so numerous countries. Again, it's the same kind of thing. They had made money every year in the past decade until last year. But last year they lost money, but they're doing a turnaround. They've been laying off a lot of workers in Spain. But while I wait for this to happen, in both these cases, I'm getting a dividend. Santander's also higher in price than what I paid for it. I paid 205. It's now above 3, but our target is above $8, and it traded well above that in the past. So I still think there's more tax loss selling on the horizon. And it's just a huge bank. It's just a major, major player. And for the third company, I'll go over to Russia, Mobile TeleSystems, and they're the biggest player in that space. So in telecommunications, television, telesports, they're in banking, etc. And that company has also been badly hit. It has come up a bit too since I bought it at $8 and change. It's a little over 9. But we think it can have a double from here. It's also in a few other countries, a few other Eastern Bloc countries, but it's a major league enterprise. The dividend is almost 10% right now, and they only pay it twice a year, so often that's a danger signal, but they do vary the dividend regularly. It's not like a lot of companies in North America who say, okay, our dividend is 4 cents a quarter or 6 cents or 8 cents. They will vary it as the company is doing. So I think the dividend, the payout could be lower in the not too distant future, but this is a very, very strong company, and it also, it's been profitable every year over the past decade. So I think there's a lot of potential there for at least a double. So one of the beauties about those 3 companies is it allows for geographic diversification. So for people who want to diversify more into other countries, other currencies, you can do it with these ones, but all of them you can buy on the New York Stock Exchange. So this way you're dealing with an exchange that you don't have to look far afield, but you're getting major league diversification. And all of these companies are of good size, all have a long history, and I suspect that all will be around for many years to come.
Yeah, it's nice when you can diversify using ADRs. It's a convenient way to do it, I suppose. Yeah. Do you find it more difficult to do due diligence on foreign companies like that?
You have to wonder a little bit. You can do due diligence, but we know that Russia is very corrupt. So when you're buying in a country like Russia, so here are the financial statements, here's what the company's doing, but are you actually getting what you're reading? I mean, China, I didn't mention a Chinese company, but again, oftentimes you don't really get what you see. So that can indeed be a problem. In terms of Dutch companies, I have a lot more faith. To be sure, in terms of Spanish companies, I also have a lot more faith. But when I put together my system and when I evaluate the companies, I do look at geopolitical risk. And we asked a lot of questions about the Russian company simply because it is based there. But it helps that it has a long history. If it was something new, it would be quite different. It is a leader in the field. They're doing deals with other major companies in the telecommunication field. So that gives me more confidence that this company is indeed the real thing.
Right. I guess that speaks to why you have one of those, I believe one of your rules is the company has to have been around for a certain period of time. And so that kind of speaks to why that's important, I suppose.
Yeah, exactly. I only like to buy into companies that have been around for at least 10 years. So this way there's more certainty for me. I'm not looking at anything brand new. Doesn't mean you can't make a lot of money in brand new companies. Or a lot of people are making money in crypto now, and a lot of people are losing money in crypto. It's just not the place where I want to be buying and selling. So automatically I have a lot more confidence. Other people can have more confidence that these companies that have been around for a long time will continue to be around.
Right. Well, that's good. Okay. So you think you'll be fairly confident you'll be able to find some buys in this year when things have been so crazy?
Well, one of the things about what we do is we're not looking to buy a lot of stocks. So if it's a big year for me, I'll look to buy 4 to 6 at this point in time. It's possible I won't. But we have something that I call the stock watch list. So on that list a few years ago, there were over 300 companies. Right now, there's about 150. So it's just not as interesting. But if we were looking to buy 20 companies, this could create some problems. But I'm only looking to cherry pick, hopefully the best of the best. And that means that I should be able to wrap my arms around some companies that are just waiting for me. Another thing that's interesting too, and I don't think I mentioned it, is I get to buy these companies on the cheap. And then at the end of the year, you have something called the Santa Claus Rally, which continues into the first few days of the new year. On average, this works out to about 0.5%. So some years it doesn't work, other years it's more, of course, it varies. But I'm looking at buying into companies, as you know, where I can have gains of 1, 2, 3, 400% plus. But if I can get a little head start of 0.5%, that's great. I'll take every little bonus that I can get in terms of creating good returns. So the Santa Claus Rally, and I love the name, it's like Santa Claus, he's on our side, let's get going. I'm happy to take that. So it's a fascinating time. I still don't know how many people do it. I think more people are focused on selling the losers than buying companies. But I'm in there. I won't say I'll be in there with both hands racing to buy things, but hopefully we'll pick up a few selections.
Perfect. Yeah, some long-term winners hopefully. So that's great. Okay, thanks, Benj. Well, thanks for your time today. Always appreciate the interesting conversation. And if you haven't subscribed, certainly be sure to subscribe. And for more great content with Benj and Phil and our other guests. So great. Thanks again, Benj.
Thanks, Todd. Appreciate it. Take care.
Have a good day. Bye-bye. Hi, everyone. I hope you enjoyed today's episode. If you'd like free access to our paid subscriber content, just click the link here and enter your email address here. And don't worry, we won't spam you, but if Contra does ever offer a major discount to the newsletter, we'll let you know. Otherwise, you'll just be receiving our premium video content through this channel. So we look forward to seeing you there. Happy investing.